What is up, everybody? It's your boy Wendy's back at it with another video. The last video I really think I talked too much, and I just want to go over again selling a put and selling a call real quick so you guys can grasp it more. And yeah, let's just get into the video. Let me show you real quick. So let's say we're doing with Workhorse, we're trading options. If you have it on, you first have to have it on to even get to this part. So first we're gonna sell a put, because let's say you don't have 100 shares of the stock and you're really bullish on the company that it's not gonna go under the price, the strike price, or even if you want to buy 100 shares and the company is good and you know it's gonna go back up, so you can sell it again. It's not gonna be an issue, which is something you should really look into. It depends on which company you're doing it with. The more premium, the more volatility, the more premium you're gonna get to. So you can see right here, implied volatility is 202%, which is very, very high. So that's why it's more. And as you can see, this was for this Friday. It's still up $2.50. You gotta remember this right here, you times it by 100. So you'll make $250 right away, saying it's not gonna go below 30. But remember, you're gonna have 3,000 in the bank. Right here, you're gonna have 3K. I don't have that, so and I'm not gonna do this with Workhorse because I don't got the money like that anymore. I already have 100 shares. So if it was me, I'd be selling a call because I already have 100 shares. So since I have 100 shares, I can say it won't go above $35 strike price, and I'll make $110 off that premium. I am saying it won't, the price right now, their share price, 30.01, will not go above $35. And I'll make $100.10 off that. So remember, you always gotta times this by 100, and you gotta times this by 100. Well, either way, this is your market price, the strike price. So what I'm saying is, if it were to hit above 35, I have to sell it at 35. Let's say Workhorse hit 40 this Friday. I cannot sell it at 40. I would have to sell it at 35, which means I lost $5, which means I lost a lot of money. So with stocks like this right now that is very volatile, you never know what you want to do. You might want to go put it at 45. Even you're making $30, but you don't want to sell your shares lower than you think it's going to be, because then you're not really making a big profit. So let's look at another company. Let me show you real quick. So you see selling a put. Let's say it's not gonna go below $12. You're gonna only make $29. The reason why, because this is a safer bet than Workhorse. The price, as you can see, we go back, look it over the 3 months. It's been going up, up, up. And it hasn't really, in the month, it hasn't really gone anything crazy. It's just been going up and down, up and down, up and down, but staying in that same range. So it's more secure than Workhorse, because Workhorse has been going up and down, very up, and then some down, but then it goes way up. So that's why you're gonna make less over here. So let's say you just sell a put for this Friday for, it's not gonna go below $12. So you make $29. You still have to put up 1,200. And let's say it did go below that. So you got assigned 100 shares. You can go back, always go back and start selling the call. So since you have 100 shares, you can sell it for, let's say you got it for $12. You can sell it for 14 if you want. You make $34. And then you still make the $2 here, because you have it for 12, you're selling it for 14. Let's say if it did hit that, be $200 more. So what I'm trying to say is safer than doing the buy call, sell call. I feel like that's more confusing to people, and that's when they get like, oh, you can lose a lot of money, blah blah blah, in trading options. But they're mostly talking about the calls over here, buy call and buy put, because this one is more confusing and you really can lose more money here, because if the company is very volatile, you never know, stuff like that. So just with that being said, the safer way to go is selling the put and selling the call. Because this way, if you get assigned 100 shares, you would just go and sell a call. And I would tell you to do this with a company that's safer. You wouldn't want to go do it with a company that's like crazy and you're like, I was gonna do it with this company, the CB company, the pharmaceutical company, when it was up $9, and I asked a friend, do you think it's gonna go down? Would it go down below the $7? And he said, nah, I don't think so. And it dropped to $2.34. So if I put the strike price at 7, I would have to buy 100 shares at $7.50. Then I would get assigned those 100 shares, that's $7.50. Then I wouldn't even be able to sell it. I'd be at a big loss right there because it's been trading at $1 and something cents, $2 and change. So you got to be careful with the company you choose. Obviously, if this was calling that would go down a put, you probably make money off of this because you're saying it's gonna go down and it's going way down. So yeah, by then you make money. But selling the put and selling the call, you would be losing money. So you always gotta make sure that the company you choose is a little secure. Do your due diligence, look it up, and don't just invest into something you don't know or know what's gonna happen. As I asked him, you think it's gonna go down? He said, nah, I don't think so. And then he's at a loss right now. He has like 100 shares of these, so he bought it in at 5. He was at a profit, he never sold, and then he got screwed over because now it's at $2. But you never know, it could go back up to $9, but you gotta see. Really gotta take some time. But anyways, yeah, I just wanted to talk about the sell call and sell put and get a better understanding out of this. And hopefully this was fast and easy, less longer than the 15-minute video that I made talking and explaining more. And this just got straight to the point. So selling a call and selling a put, I feel like it's safer than anything else. And selling a put, you get the put. If you get the premium, you never have to sell. You never get assigned the 100 shares. Then you're chilling. You do it again next week. But if you get assigned the shares, you can start selling the call, and you still make profit. And let's say you don't sell them, keep doing it until you sell them or don't want to sell them. It's up to you. But you still make money this way, and it's safer than the other way. So yeah, it's your boy Wendy's boy, and thank you again. You guys are freaking amazing. Thank you so much for supporting me, liking, and I hope I gave you a little recap and simplified it in this video. Again, I'm not a financial advisor. I don't know what the hell I'm doing. Until the next one, we'll talk about Workhorse and SHLL. If you haven't got on those two, you are slacking. Don't beat me. Be a winner. Invest like a boss. Peace.